Joining me now to talk more about this is Mark Luschini. He's the Chief Investment Strategist for Janney Montgomery Scott. John and Dominic with me as well. Now, Mark oversees more than $50 billion in assets. And Mark, you just heard Sam Zell basically put the blame of volatility onto Obama's shoulders. What do you really think is behind volatility?
Well, I think that's certainly contributing to the volatility, but I don't think it's isolated to that fact, because obviously we're dealing with issues here both in terms of the domestic economy and as well with what might wash ashore from the European community's efforts to wall off contagion into the more economically important countries like Italy, particularly, and Spain. So, as well throw in China and their effort to tamp down their bout of inflation, which could throw the world's growth engine into some type of economic relapse, which would have untoward effects on a global basis. So there's a lot of issues that are leading to this uncertainty, but I agree with Sam Zell completely in terms of the unevenness we're seeing in the economy and in the financial markets in particular, where it's being manifested is largely due to the enormous amount of macro uncertainty that investors are dealing with.
Yeah. Oh, Mark, it's Dominic here. One of the things, we talk about this vicious cycle, at least traders on the floor of the NYSE do, this idea that all of this uncertainty breeds to people not wanting to play, which leads to lower volume, which leads to more volatility, which leads to less volume. I mean, how much of this is really about this vicious cycle, and what is it going to take for investors to really say, you know what, I'm ready to kind of step into this market with a little bit more certainty here?
Well, what's missing at the moment is the proverbial animal spirits, the enthusiasm for equities, given the fact that there's more visibility to how things look. Unfortunately, what's being masked at the moment by these enormous macro issues is the fact that corporate America, as we all know, is in great shape. And in addition to that, corporate profits by the end of the third quarter this year will, on a trailing 12-month basis, exceed that of the peak in 2007. And yet equity markets are still over 20% below the levels that we achieved 4 years ago. So I think what we need to see is some stream of economic data that's more consistent and indicative of the aversion of a recession, and some policy coming out of our administration that is more consistent as well in terms of what's going to be done collectively, both fiscally and monetarily, to try to drive job growth, which is the missing link to a sustainable economic expansion.
Mark, it's John Erlichman. In the meantime, investors like dividend-paying stocks. I want to show our viewers some of the highest paying dividend yields in the Dow Jones Industrial Average. You're going to get it from phone companies like AT&T or Verizon. You're going to get it from healthcare companies like Merck or Pfizer. And even Intel's paying you a dividend yield of 4%. Any of those stocks that you like?
John, frankly, all of those stocks would be ones that we would point to as positions that are worthy of being held in a portfolio. I mean, we've been strong advocates of high dividend-paying equities, primarily because if you look on a valuation basis, they're cheap. The market in itself is relatively cheap, and within the market, those named companies are even cheaper. And in addition to that, not only are their dividend yields a buffer against the volatility that we're likely to continue to experience in the equity markets, but consider the alternatives. Cash yielding next to nothing, the 10-year Treasury offering just a little north of 2%, which allows you to lock in at negative real rates of return. 4, 5, 6% dividend yield is a huge advantage, and we think investors ought to be sponsoring those kinds of names in their portfolio.
Quickly, though,
yes,
there's no doubt, though, that that we need to have less volatility to get more people back in the market. So what's going to calm down the markets then?
Well, I think one is, of course, the regulators need to look at this high-frequency trading activity, because unfortunately, like was alluded to earlier, the machines on many days have taken charge of trading. I mean, we had that stretch a couple of weeks ago for 4 consecutive days. The market was up or down by 400 points, which was unprecedented in the Dow Jones Industrial Average's history. And unfortunately, I think that is what's continuing to lift anxieties that investors have with regard to investing.
Mark, thank you. Really appreciate it. Mark Luschini of Janney Montgomery Scott.